What's going on, guys? Welcome back to another video. So in this one, we're going to be going over exactly what's going on with the market right now. You guys all know this is going to be an absolutely crazy week, and I'm here to break it down for you guys as simple as possible. And we are in for some absolutely insane moves. We're going to go over the SPY, the rate hike predictions. We're going to be going over a little bit of the unemployment situation as well. And as we like to talk about here too, the situation with the energy crisis and how that is going to affect inflationary pressures going forward into this marketplace. So again, guys, before we get into all of that information, if you do enjoy the information and analysis that we provide for you guys in these videos here, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who want to learn. So if you wouldn't mind, hit that button here. And if you do want to see more videos like this, make sure you hit that subscribe button and hit that notification bell too if you guys want to be notified every single time I post videos just like this. But let's get into it right here and take a look at what we are seeing with the overall market here by looking at the SPY, the SP 500 ETF. So looking at the SPY today, well, we did end up seeing that little bit of a gap down in the pre-market trading session here, but then we started to see a little bit of this rally up. Now, towards the end of the trading days, over the last couple of weeks here, we have seen sort of these nonsense pumps and then these gap downs the day after. Now, is that going to happen tomorrow? Well, it's anybody's guess the day before the FOMC meeting, but I want you guys to think about very, very critically is who are the large market participants that are able to move the markets. Now, I kind of gave it away there, but it's large market participants. Why would they be buying right now, right ahead of a very, very important event coming up on Wednesday? And we're going to talk about that in a second as well. But throwing this on the 4-hour time frame here, we are going to see some pretty interesting things. So we have this 4-hour 1348 cross down right here, and we have sold off pretty significantly. Now we are coming up to retest that 13 EMA right here, and we could easily see some more downside as this is kind of going to serve of a breakdown and then a retest back to the upside for potentially more downside coming. Now, when we're thinking about these interest rate increases, well, what is the probability and what are people actually scared of in this market right now? So laying out the playing field here, kind of all of the pieces of the chessboard on the table, here's what we're looking at. So when we're looking at the Fed Watch tool here for this meeting coming up on Wednesday, we have an 18% probability of a 100 basis point rate hike and an 82% probability of a 75 basis point rate hike. So the expectation right now is that we're going to get a 75 basis point rate hike. Now, I would actually agree with this. I think 100 basis points would be a little bit aggressive, especially with where the Fed is right now. But what you also have to think about is that after Jerome Powell's statements at Jackson Hole, where he essentially said that the public doesn't necessarily seem to think that the Fed is actually going to follow up on its word and make sure that they're going to do everything that they need to do in order to get inflation under control, he kind of came out and said that the Fed is really focusing on inflation right now. Now, that doesn't mean that they're going to be kind of switching their mandates around. The Fed has a dual mandate: price stability and taking control of the labor market. They're still going to be focusing on the unemployment rates and things like that. But when you think about the unemployment rate right now, it's sitting at or around 3.7%. And kind of the threshold for when Powell is going to start to get some political pressure of what he is doing with rates would be at around 5%. So the Fed does have a little bit of wiggle room to increase rates further and see unemployment start to head up and actually kind of lessen some of those demand push side inflationary aspects to the situation that we're dealing with right now. Because when you think about it, well, if people are going to be working less, average hourly earnings are going to be coming down, well, then people are going to have less money in order to spend out in the market in terms of their discretionary income, and you could see prices come down as a result of that. And again, guys, before we go any further, I do want to highlight some of our members in our group over here absolutely crushing it every single day with 1348, our algorithms, our live streams, our curriculum. And when we're looking at this right here, Diana, 4% day, Black Betty, 3% day here. We have some other really, really solid gains here. These people are taking control of their portfolios every single day. If you guys are interested in joining us over there, make sure you guys check out that link down below. But again, coming over to this unemployment situation right here, just like we were talking about, in August, the unemployment rate rose by 0.2 percentage points to about 3.7%. So you are seeing unemployment start to tick up. Now, with the market craziness aspect that we are looking at here, here's where things actually get very, very interesting. Now, I want to start talking about treasury yields here. The treasury bond yields hit 11-year highs as investors brace for the third consecutive Fed interest rate hike. Now, we do have that yield curve inversion, which we can talk about as well in a separate video. But in order to make this very, very simple for everybody, because I know a lot of these financial terms and how things affect each other can be very, very complex, what I want you guys to think about is the stock market and the bond market as almost inversely related. They aren't actually, but in terms of the flow of money, bonds are typically going to be a much less risky asset class. Stocks in general are going to be a lot more risky. So when you look at the relationship between the stock market and the bond market and what the treasury yields are actually doing, it gives you an understanding of where is money flowing in the actual market right now. Now, thinking about how bonds are actually priced and how they work, well, when you see bond yields go up, prices are going down, meaning that there's less demand in the bond market. Now, when we're looking at this right here, treasury yields hit 11-year highs as investors brace for third consecutive Fed interest rate hike, yields up, bond prices down, less demand in the bond market, or maybe even more supply, and people are selling off more bonds. Now, if you were to typically see a lot of bond sales going through and a lot of these yields starting to come up, well, you would then expect, okay, maybe people are starting to go a little bit more risk on, but they're not. When you look at the daily or even the weekly chart of the SPY right here, you have seen a pretty significant sell-off from the highs that we have seen. So what does this tell us? A flight to cash. You are seeing a very, very interesting phenomenon here with the overall market, with a lot of cash sitting on the sidelines. Now, these cash assets might be put into either hedges on other long-term positions, but there's a lot of cash on the sideline here. Now, are we going to get that light out of the light at the end of the tunnel coming up this Wednesday from Powell? Most likely not. When everybody's expecting this 75 basis point rate hike, well, when what's really important are the statements that Powell is actually going to make. Now, again, when we're looking at this 10-year treasury yield right here on the 1-year time frame, you can see that this thing is absolutely skyrocketed over the last year and hit highs today of about, I believe, about 3.51%. These are very, very high levels for these treasury yields to be at. Now, this flight to cash can create a lot of volatile moves. Are we going to continue to see this flight to cash and more money getting taken out of the market, and we end up coming down to, let's see, we might end up hitting, we throw this back on the daily time frame here, coming down to those previous levels here, right around this 380, 379 level, or even breaking these previous lows at around 362? Well, it's really going to depend what is said on Wednesday when Powell comes out and actually does that question and answer section. Now, the other thing that we need to think about here is the main problem that is affecting things in this overall market right now, and that is energy. Now, coming over to this article right here, we can see that U.S. gas producers are struggling to meet demand, and we can go through all of these charts right here and kind of start to break everything down. But what you really have to think about is if these gas producers are struggling to meet demand right now, what is going to happen when demand upticks in the winter? We've seen energy prices start to come down a little bit, and that did kind of feed into the slightly lower than it wasn't lower, but the inflation basically missed expectations last week when we saw those CPI numbers come out, when everybody was expecting, maybe a CPI beat, when it actually came out and missed expectations. So this did feed into this whole situation here. But at the end of the day, with what we're looking at with oil right now, with prices already well above the long-term average, many portfolio managers are betting there is scope for them to retreat if winter temperatures are close to normal and there are no major output disruptions. But with the low level of inventories means there are few shock absorbers. The system will quickly come under pressure if this winter's drawdown is towards the top end of the historic range or exceeds it. So there's a lot of very, very important basically aspects of the overall macroeconomic environment that are at key breaking points right now. We need to see what happens with the unemployment numbers over the next couple of months as Powell continues to raise interest rates. Again, we are going to be getting that 75 or 100 basis point rate hike coming up on Wednesday, but the key thing to really look out for is what is going to be said by Powell. What is the guidance? Is he going to kind of stick to his hawkish outlook that he gave back at Jackson Hole? Or is he going to be able to back off a little bit? So guys, that is mainly going to wrap up this video here. If you did enjoy the information and analysis that I provided for you guys in this video, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who do want to learn. If you guys do want to see more videos like this, make sure you hit that subscribe button and turn on that notification bell so you're notified every time I post a new video. So hopefully you guys are having a great evening. I'll see you guys in the next one. Peace.